Hi everyone, thanks for tuning into my channel, All Things Accounting. Today, what we will be examining is liquidity analysis. In particular, we'll be going through some liquidity ratios. So stay right there and we'll go through this together. So liquidity, what does liquidity mean? Really, it's the company's ability to pay off its debts as they come due. There's a certain number of ratios that we can look at to help us determine the financial health of a particular company, especially in paying off its debt. So first one we look at is working capital. So what does working capital mean? Current assets minus current liabilities. Okay, so current assets minus current liabilities. So normally, ideally, you would want the current assets to be in excess of current liabilities. So current assets, remember, are those things that will be either converted into cash or will be consumed in less than a year. The current liabilities are the obligations that require current assets to satisfy in a year. Second one here is the current ratio. So the current ratio here involves current assets over current liabilities. So ideally, you would like this ratio to be about 2-to-1. So you want your current assets to be at least twice of what your current liabilities would be. It's a very widely used ratio, and it's a sign of short-term financial health. The concern in using the current ratio here is the composition of the current assets. So sometimes inventory has a lot of markups and it requires the sale and the collection of money versus, let's say, accounts receivable, where it's just one step away from being converted into cash. Therefore, the next ratio here is the what we call acid test, or the quick ratio. So this involves quick assets, and I will define what quick assets are, over current liabilities. So, as I mentioned before, there's some subjectability in terms of current assets. So quick assets here, these are such things as cash, short-term investments, and current receivables. And current receivables. So it's a stricter test of a company's ability to pay off its current debts. It excludes inventory and prepaid expenses. So a ratio of less than 1 is not desirable because it may signal the need to liquidate marketable securities in order to pay off its upcoming bills. Next one that we'll look at is the accounts receivable turnover ratio. And this is calculated as net credit sales all over average accounts receivable. So if you're looking at comparable of 2 years, let's say 2020 and 2021, then you'll take the accounts receivable for 2020, add it with 2021, and then divided by the sum of both by 2 to find the average. So this particular accounts receivable ratio here measures the number of times that accounts receivable are being collected in a particular period. Because sales normally covers a particular period of time, usually a year, then you want to calculate the average to the average accounts receivable to be covering that same time period as well. Companies usually want to extend credit terms to customers to a liberal amount in order to attract and maintain them. However, the management still has to control and monitor these particular customer accounts to make sure that they're still being collected on a timely basis. The next ratio that we'll be looking at is the number of days sales in receivables. And that's computed as number of days in the period all over accounts receivable turnover ratio. So what this tells us, it's a measure of the average age of accounts receivable. If the accounts receivable turnover, for example, let's say if this was about 4.8 times, and this one was about 360 days, if we were to calculate this, it would be 360 divided by 4.8, and that would yield about 75 days. So we have to question, is that bad or is it good? Well, that ultimately really depends on the policy of the company. If the company has a policy of about 60 days, for example, that they want their customers to pay by, well, then that may warrant a 75-day computation there, may warrant further investigation to see if the company's policy is up to date. Some revisions have to be made, or they might have to be a little more aggressive in collections. Our next ratio that we're looking at is called the inventory turnover ratio, and that's computed as cost of goods sold all over average inventory. So this particular ratio here measures the number of times that inventory is sold during a period. So the higher that the number is, that means that the more efficient the company is at moving its inventory out and selling it. The last ratio that we just be looking at today in terms of liquidity is the accounts payable turnover ratio, and that is computed as purchases over average accounts payable. So what does this mean? It means that it measures the number of times that accounts payable are being paid throughout the year, or in this case, certain periods. So the higher that the number is from one year to the next, that means that the company they may be more prompt in paying their accounts to other companies that they're owing. Now up here, cost of goods sold, I've made some videos on cost of goods sold and how to compute it. So if you haven't watched them already, that may be very useful if you're not aware of what cost of goods sold is. So I hope this tutorial was very useful to you. If you found it very useful and you liked it, please subscribe to my channel. Please hit that like button and click the bell notification icon so that you're always up to date on the new tutorials that I'll be posting. So until next time, take care.